Markets are closed. It is Saturday. And this is when the architecture of the next week gets built. Silver closed at $84 in the West on Friday. Shanghai is pricing it at $96. That is a 14.5% premium of Eastern physical metal over Western paper contracts. And that gap has been moving in one direction across recent sessions, higher. The sequence reads 13.5%, 13.88%, 13.7%, 14.5%, 14%, and now 14.6%. That is not noise. That is directional movement. And it is telling you something precise about where real demand for physical metal is concentrated. Here is the layer underneath that. Professional buyers have been pulling physical silver out of the COMEX every single trading day. Institutional hands taking delivery of real metal consistently, session after session. And at the exact same time, the Sprott Physical Silver Trust is trading at a 5.7% discount. Western retail has not come back to silver at all. For those who understand market structure, that contrast is everything. In 2011, the Sprott Trust carried an average premium of 17.3% across the full year. Right now, it sits at a 6% discount. That tells you this move is not being driven by Western speculative sentiment, which means it has not been contaminated by the kind of froth that collapses fast. And it means that if Western retail does eventually return, when the price action becomes impossible to ignore, the premium shift alone compounds the return significantly beyond the physical price move. That spread from discount to premium is a multiplier. This is a structural setup, not a hype cycle. Now, none of this silver data is moving in a vacuum. The geopolitical picture must be framed directly, because since Friday, the situation has not calmed. It has escalated on multiple fronts simultaneously. Going into the weekend, WTI posted its biggest weekly gain since 1983. The Strait of Hormuz was functionally closed to Western-linked vessels. Over $900 billion was wiped from U.S. equities in a single session. That was the setup. Here is what has developed since. Iran struck a multi-flag tanker near the Strait of Hormuz. The U.S. military is now preparing to deploy a third aircraft carrier to the Middle East. One carrier is a presence. Two is a warning. Three is a different operational posture entirely. Israeli forces completed extensive overnight strikes across Tehran and on military infrastructure at Mehrabad Airport. The U.S. struck a freshwater desalination facility on Keshem Island, a meaningful escalation in target type. Iran's foreign minister has warned of consequences, and a U.S. intelligence assessment concluded that even a large-scale military campaign is unlikely to fully remove the Iranian government. That assessment coming from inside the U.S. intelligence apparatus means there is no clean or near-term resolution being planned for. On the diplomatic side, statements from Iran's president suggesting attacks against neighboring countries will stop have been read by some as a peace signal. They are not. Iran is not talking to the U.S. or Israel. It is talking to its neighbors. That is a pressure move aimed at driving a wedge between Gulf states and the Western coalition, not a genuine offer to stand down. The strikes are continuing. Trump simultaneously declared Iran beaten and threatened complete destruction. Those two statements cannot both be true at the same time. That contradiction does not resolve into stability. It signals a conflict still in motion. Oil crossed $100 per barrel this weekend, starting with Oman crude confirming above that level. Oman crude is the primary pricing reference for Middle Eastern oil flowing into Asia. When that benchmark moves, it matters. The strait remains restricted, and that number tends not to stay isolated. And now Qatar has declared force majeure on LNG exports after shutting down the Ras Laffan facility, one of the largest LNG production complexes on the planet. Qatar supplies roughly 20% of global LNG, a month or more to return to normal output. That is not a price spike. That is a structural supply shock landing on a market already under stress. There is also a direct U.S. strategic angle worth noting. The head of the National Energy Dominance Council stated publicly that the U.S. ultimately will not need to worry about the Strait of Hormuz because the goal is to get oil entirely out of the hands of those currently controlling it. That is not hedging language. That is an articulated strategic objective. And it implies the disruption timeline is not measured in days. Europe is the most exposed. Before Ukraine, they ran on cheap Russian pipeline gas. That is gone. They replaced it with expensive LNG. And now Russia is redirecting its remaining LNG flows to China and India before the EU ban even takes effect. Qatar is offline. The Hormuz corridor is restricted. Gas prices are already up over 50%. The U.S. supplies more than half of Europe's LNG, which means Washington now holds the pricing lever for European industrial output. If this runs for weeks, the conversation stops being about price spikes and starts being about factories that close and do not come back. Jim Rickards laid out the mechanics of this trap precisely in Currency Wars. Energy price shocks create inflation that rate policy cannot touch, because the root cause is supply disruption, not demand expansion. raise rates into a supply shock, and you crash the economy without solving the price pressure. There's a broader framework worth examining here. Wars near major energy choke points function as a form of global silent tax. Oil is priced in dollars, which means every country on the planet that needs energy must first acquire dollars to buy it. That constant global demand for dollars is not accidental, it is the architecture. Energy demand becomes dollar demand. The revenues then concentrate among a small group of producers, and a significant portion of that capital historically recycles back into U.S. government debt markets. The incentive structures this describes are visible in the price data every time a conflict flares near a choke point. Now, the China picture. And this is the detail that ties everything together. The People's Bank of China increased gold holdings in February for the 16th consecutive month. 30,000 troy ounces added, bringing total holdings to 74.22 million fine troy ounces. The World Gold Council noted that global central bank buying slowed broadly at the start of the year. Net buying totaled 5 tons in January against a 12-month average of 27 tons. China did not slow. China continued. Gold is now above $5,170 in the West, and Eastern demand is not softening. Buying is still outpacing selling, and the concentration of buyers remains in Central and East Asia. The same geography driving the Eastern silver premium wider every day. Now the short covering story in silver, because this is one of the most significant structural shifts in years, and it is getting almost no coverage. For the first time in literally decades, silver is no longer the number one commodity by days to cover on the concentrated short position chart. Platinum has taken that position. The reason? Big 8. Commercial traders in silver have been aggressively covering short positions over the past 6 months. Positions 5 through 8, the smaller commercial traders, now hold their smallest short positions on record. The 4 largest traders still hold a significant short, appearing concentrated in just 2 U.S. banks. But the paper mechanism that contained price discovery for decades is losing structural capacity. The Commitment of Traders report is a public weekly document. The trend is there for anyone who looks. The bear case is real and must be stated. Paper markets still dominate short-term price discovery. A ceasefire rumor, a DXY reversal, or a coordinated algorithmic flush can push silver down fast, regardless of physical tightness. The COMEX leverage ratio still sits near 7 paper ounces for every registered physical ounce available for delivery. The gap between physical reality and paper pricing does not close in a straight line. It closes in an event. For long-term stackers, the structural deficit does not care about a bad week on the tape. The short covering trend is a multi-year signal, not a weekly one. Watch the Shanghai silver premium. Watch whether COMEX registered inventory holds or continues draining. Pull the COT data. It is public and updated weekly. The PBOC purchase figures came directly from the central bank. The COMEX inventory reports are updated daily. Verify everything. Invest with logic, not hype.